Hey everyone, it's Rich Warner from WealthMaxBuilder.com. This is another video lesson from the Basics of Investing series. In this lesson, we're going to talk about passive investing versus active investing. And I'm going to show you why it's a good idea to concentrate and focus on becoming a passive investor rather than an active investor or a trader. Let's get into it. There have been several studies that have analyzed the performances of individual investors over the past few decades. And among them are studies by the Dalbar Group. And they clearly show that the average investor does not do nearly as well as expected. When you compare the average stock investor's performance over long periods of time, the returns are less than half of what the benchmark indices have generated. The same holds true on the fixed income side for bond investors. Over this period of time, from 1990 to 2009, for example, 2 decades, the Barclays Aggregate Bond Index generated average annual returns of 7%. Over that same time period, the average individual bond investor generated only 1% returns. So if you average out the average stock fund investor and average bond fund investors' returns, they're even lower than the rate of inflation. So rather than building and generating wealth, investors have actually been generating negative real returns. It would have been better off for them to actually spend their money rather than save and invest it, let alone take advantage of the power of long-term compounding of growth. But it's important to ask ourselves, why is this the case? Why are average investors really such poor investors? And even more important, what can we do to combat this? These are clearly weaknesses that we face. These are clearly weaknesses that we're talking about here and that we have to address. And without adding too much more insult to injury, here's another study by the Dalbar Group that shows just how poorly the returns have been generated by individual investors versus the benchmark indices. What it really boils down to, and what most individual investors are confused about, is this notion of active versus passive investing. Active investing is more of the trader mindset, flipping stocks, buying stocks and selling them, getting in and out of certain investments along the way, even to the point of flipping condominiums and flipping real estate inside of very short, unreasonable time frames. Passive investing, on the other hand, is more long-term. It's more of a marathon. And it's not so much about timing the market or getting in and out of things. It's more about setting an overall asset allocation, a pie chart, if you will, where you're determining what percentage of your assets is going to go into stock funds versus bond funds, essentially. And you can get more aggressive inside those allocations. You can go for more small cap versus mid cap versus large cap or international stock funds. And the same thing holds true on the bond side. But essentially, the important thing is that you get the asset allocation right between stock funds and bond funds. You set it and forget it. Just rebalance once a year. This is passive investing. We're not staring at the screens. We're not checking out CNBC or Bloomberg TV or what have you, or watching these stock TV programs that are telling you to get in of this company and out of this company. No, none of that. Passive investors should shut off their screens completely and just follow a set asset allocation. And believe me, if you do this, your performance is going to be significantly better than any sort of interventionist trader active strategy can generate. What it boils down to is, asking yourself whether you're a trader type or an investor type. Are you a short-term flipper, interventionist type of active trader, or are you a long-term passive investor? That's the essential question. And I would suggest that either investment approach appeals to different parts of our brain. Our human brain is quite a complex mechanism, and it's comprised of different functional parts. We have what is known as the irrational, the reptilian brain, which is very sort of knee-jerk reaction, very emotive, instinctive reactions to things, impatient, and also happens to be very egotistically based and self-centered. I would suggest that this is the trader mentality in us, the need to prove that we are competitive and greater than the average. All of this instinctive reaction, knee-jerk reaction type of approach, very short-term thinking, not thinking about the long term. In juxtaposition, we have the rational part of the brain, which is more located along the top lobes, if you will. The prefrontal cortex, for example, is the last part of the brain to develop in humans. These areas of the brain are more metacognitive. There's more rational thought involved, process thinking, delayed gratification, the willingness to postpone an immediate gratification in order to get something greater in the future. This part of the brain is also more community-based. Instead of focusing on the I and me, the ego, it's more of a we sort of mentality, a we type of thing, that, being aware that you're part of a greater whole. Metacognitive, the ability to be aware that you're even thinking in a certain way. That's the metacognitive thought process. And it also happens to be, it's less combative, it's more of a patient sort of approach. These characteristics are more suited to the passive investor. You could say that the point of this particular lesson is to get you out of the reptilian mode of investing and get more into the passive, rational, delayed gratification type of approach to investing. Here's a slide that basically sort of juxtaposes passive and active investing. Active investing is, once again, very in and out, higher intensity of trading frequency, and also I would add stress levels, because you're subjecting yourself to constant awareness of the pulses of the market, and you're just taking all those ups and downs of the market. You're feeling it almost. You're taking it all in. And the more you trade, the more commissions you have to pay. The more bid-ask spreads you have to pay. So there's higher slippage and commission costs associated with active investing. In contrast, passive investing is long-term. There's hardly any trading involved. Once you set your asset allocation at the beginning of the year, there's no more trading for the rest of the year. You're basically rebalancing once a year. So that keeps the commission and slippage costs really low, and it focuses on the big picture, and it's a lot less stressful because you do not have to look. In fact, you should not look at the performances of your stock funds or your bond funds over time. You should not take that in. It's just go with a very solid investment strategy and run with it. Now, having said that, I'm not trying to preclude the possibility that active investing is, totally evil. There are certain investors out there, and certain traders out there, I should add, that are very, very good at what they do, but they are rare and far between. Most individuals just simply are not in that group. We have to acknowledge that. The Dalbar studies prove that the average individual investor is just not suited for active trading. So in this slide, I would just like to highlight what are the possible advantages of active investing as well as the disadvantages of active investing. I would say one of the greatest arguments that you can make in favor of active investing is this ability to preserve capital in bear markets. That is timing the market. If you have access to some sophisticated market timing model, and if you could call the bottoms of the markets and the tops of the markets, then you'll know pretty much when to buy the market, at the troughs, and get out near the peaks. And if you can do this consistently over long periods of time, then it could be said that you are a successful market timer. And this ability to sidestep bear markets, such as we had during the tech bubble between 2000 and 2002, and then once again 2008, 2009, if you have this ability to sidestep the markets at the peaks and get in again at the troughs, then you are a stock market genius. And there are people who have that skill set, but it's more than just being able to read a chart. I mean, I will concede that in a chart such as this, that there are trends and you can notice them in some way, shape, or form, but most people just aren't aware of these trends going up and down, nor do they have the psychological fortitude and discipline to implement a trend model, for example, successfully. Another type of active investor is one who perhaps doesn't concentrate as much as timing the market as in picking the individual securities to comprise a fund. So a Warren Buffett, for example, is somewhat of an active investor, even though he's a long-term investor, but he may be considered an active investor in the sense that he is selecting individual securities that he believes will outperform the benchmark indices. And over history, he's proven that to be the case, that he can create alpha. Alpha is a term that refers to the ability to outperform a benchmark index. So if you're generating alpha, you're beating the benchmark index. And so Warren Buffett has proven historically that he can beat benchmark stock index. And lastly, it can be said that for very sophisticated investors and institutional investors, particularly, incorporating an active strategy into your overall portfolio of investment strategies may be a good idea. It could add diversification to your whole approach, and there is an argument there indeed. But for individual investors, I think the disadvantages of active investing outweigh the advantages. As we mentioned, there are significantly higher trading costs due to the increased frequency of trading. Second, it is extremely difficult to time the market, to know when to get in and out, and then also to have the discipline to follow a market timing model over long periods of time. Let me give you an example. Let's say, we've just experienced a huge bear market. The tech bubble burst, or in 2008, 2009, stock market was down 50%, and in some cases more. And all of a sudden, your market timing model is flashing a green light. It's saying, go long. Now, part of your brain is reading the papers, and you're reading about all these stories of companies just losing money. The government is releasing labor statistics that are showing extreme weakness in the economy. How could this economy possibly turn around? How can these companies possibly flourish in such a weak economic environment? And yet the stock market is flashing a green light on your market timing model. Do you have what it takes to buy at the trough here, to buy at the bottom? I mean, it takes a lot of guts to get in it at the bottoms here without second guessing your market timing model. If you're riding a long-term uptrend and you're near the peak, and your market timing model all of a sudden flashes a red light, get out of the market or go short the market, do you have what it takes to go short against what the majority of people are thinking? Keep in mind that near market peaks, everyone is a stock market picking genius. I mean, you go to Thanksgiving dinner around a market peak, and everybody's sort of bragging about how much money they made in this stock and that stock, and I did really great in this technology company, and we should all get on board and everything. You're taking in all this information, and the stock market reports are all positive. The economic reports are all, very rosy and everything. But when your market timing signal is flashing a turnaround in the market, in the face of all this good news and complacency, as it were, do you have what it takes to follow that signal? I would argue that very few investors have what it takes to follow market timing signals, especially when it goes against the majority opinion and what most of the investment community is thinking. Another disadvantage of active investing is that it's very hard to select the right securities if you're trying to create alpha, as Warren Buffett does, for example. Do you have the financial analysis skills to select outperforming companies? Yes, today we do have access to screening programs and software that can help us sort of filter out more competitive stocks and such. But even in the face of all these software programs, it still seems as though most individuals do not have the ability to beat the benchmark index. I mean, even professional stock market pickers, fund managers at mutual fund families, do not have the ability over extended periods of time to create alpha. There is something known as mean reversion, that over very long periods of time, even the star managers fall back to the averages. This appears to be a fact of life because they're changing market conditions and changing styles as well. So it's very hard to generate alpha and to continuously, through good markets and bad markets, select companies that are going to beat the benchmark indices. As we mentioned, because of the increased trading involved with active investing and active trading, I should say, you have higher commission costs and slippage costs, which also acts as a drag on your performance. And finally, say you happen to find a star fund manager who happens to have excellent market timing and stock picking skills, let's say. Will that star fund manager be around for a long period of time? Do you have access to this fund manager? This successful star fund manager may leave to create his own hedge fund somewhere, and you may lose access, or you may have to pay significantly higher management fees to get access to his or her skill sets. So these are all factors that should be weighed into your consideration as to whether you want to go the active versus the passive investment route. Here is a slide that basically shows the emotional roller coaster ride that most wannabe active investors sort of go through along the way. And as you can see, these are all emotional kind of knee-jerk reaction thought processes. Buying near the peaks, feeling as though you have to jump on the bandwagon even if it's late in the cycle, experiencing the pain and frustration of a significant down move in the market or in a company stock, getting out near the bottom, thankfully, and once bitten, twice shy, being reluctant to get back in again when the tide is turning and everything is starting to go back up again. I mean, these are all emotional considerations that many investors go through and that account for the poor performance as per the Dalbar studies, and that most individual investors we don't have the brain to accommodate both a passive and an active approach, and that if you have to choose, it's best to just kill the reptilian part of the brain and go with something that is not going to subject yourself to this emotional roller coaster ride. But before we beat up the individual investor to the ground here, let's also consider the fact that the pros are not beating the benchmark indices either. There's been a significant failure by most star fund managers to outperform their respective benchmarks over time. So don't feel bad if you're not generating the returns that you should be. There are star fund managers who are getting paid handsomely to generate mediocre returns. If most of the time fund managers are not able to beat their respective benchmark indices, well then go with an index fund instead, where you don't have to pay those high fees for the star fund manager. I mean, this is happening in virtually every asset class and subsector that you can imagine. Here we're talking about all the sectors of the stock fund management industry. This underperformance by star fund managers is clearly noticeable in the international equity fund sectors especially, but also in the U.S. mid-cap sector as well. As news of this has spread, and just getting your brokerage statements and recognizing that you're not meeting the standards of the benchmarks over time, investors and financial advisors have been wisening up. They're basically saying, hey, why should I pay these extra management fees for these star fund managers when the benchmarks are doing just fine, thank you, and the index funds are charging significantly less than the star fund managers? People are voting with their pockets, and they're starting to move money out of actively managed mutual funds. I would say this is more prevalent on the equity side than on the fixed income side. And they're putting their money into ETFs, which are exchange traded funds particularly, and mutual fund index funds. Again, all the index funds are trying to do is replicate the benchmark index. There isn't any of this in and outs picking of really competitive companies and none of that. It's really just, go with the benchmark index. This is what we have. This is our objective. And so the more important question is, how much are you going to allocate to that particular index fund or sector within the asset class? Here's a slide that basically shows how much more expensive the active fund approach is versus the index fund approach. I mean, we're talking about index funds on the equity side and bond side that are 10, 15 basis points a year. Compare that to 80-something basis points, which is almost a full percent a year for the active fund approach. Indeed, just recently, Fidelity Investments announced that they're no longer going to even charge a management fee. The management fee for their broad stock market index fund is zero. So that is even lower than Schwab and Vanguard, which have been historically, the pioneers of deep discount fund management. And as mentioned, there's been a significant switch out of active fund management into index fund management, as noted by mutual fund and exchange traded fund flows. So one of the essential questions we need to address is whether ETFs are better than mutual funds or not. ETFs, which stands for exchange traded funds, have come onto the scene much later than mutual funds. We all know about how Fidelity Magellan was around, and PIMCO and Putnam and American funds have been around for eons, it seems. And then these exchange traded funds came along, and they offer certain advantages over mutual funds. One of the biggest advantages is the liquidity of ETFs. You can literally get in and out of an ETF anytime during the trading day. Whereas with a mutual fund, you have to wait until 4 p.m., enter your order with your brokerage firm, and they'll take care of it at the close. And you'll get the closing NAV price of the mutual fund at around 4 p.m. Eastern Standard Time. With ETFs, that's not the case. You can get in at the market open. If you change your mind like 2 hours later, you can do that intraday if you wanted to. Another significant advantage of ETFs is that, the fund holdings are completely transparent. There is no 30-day delay as there are with mutual fund families as far as reporting positions in the fund or holdings in the fund. Mutual funds are slightly more inaccessible for investors because the minimum investment sizes are often $1,000, $2,000, $5,000, even as high as $10,000 or even as high as $100,000 in some cases. ETFs, you can basically buy one share for the going price. So if you're interested in buying the S&P 500 index, the SPDR, ticker symbol SPY, it's about $290 a share. So that's much lower than, let's say, having to plunk down $1,000 minimum for an S&P index mutual fund. There are also higher transaction fees for getting in and out of mutual funds, and sometimes getting into a mutual fund may cost more on the way in some cases. This is not the case with ETFs. You basically pay your commission rate as you would buy or sell any stock share. So much lower transaction fees, transparency, liquidity. There are some tax advantages also. And as we mentioned, the management expense fees are much lower, generally speaking, for ETFs than they are for mutual funds. So in practice, I think it makes sense to go with ETFs versus mutual funds in general. There are some exceptions, however. These days there are literally thousands of mutual funds and ETFs to choose from for every asset class under the planet in both the stock and the bond universes. I generally prefer ETFs because of the liquidity, the transparency, the lower management fees, and lower transaction costs. I think a more important question is whether or not you're going with an index fund versus an active star mutual fund of some sort. It's important to note that even in the mutual fund approach to things, there are index funds. A lot of people get confused about this, but you can find index funds on both the ETF side of things as well as the mutual fund side of things. It's just that when you say mutual funds, typically you think active star fund manager, Peter Lynch at Magellan type of thing. No, it's actually possible to buy quite a few index funds in the form of a mutual fund, particularly at Schwab and Vanguard. And a more important question to ask is whether your brokerage firm enables you to purchase and or sell ETFs as well as index mutual funds. But in general, you can buy any ETF through any brokerage firm these days. Now, more than 90% of the time, I'm going to go with an ETF index fund. And there are times when I'll go with an index mutual fund. But there are certain rare occasions when I will still go with a star fund manager. And this is particularly on the bond side of things. There are certain specialty areas in the bond market where a star mutual fund manager has done consistently a great job and outperformed the benchmark indices consistently and with a low risk type of approach. But those are very few and far between to find, so I do not encourage this approach for most investors. Generally speaking, you want to go with an ETF index fund, and if you can't find it as an ETF, then as an index mutual fund. Here is a slide which shows some of the big time ETF providers. Biggest one happens to be iShares, which is owned by BlackRock. They have over $1 trillion in ETFs under management. In second place, we have Vanguard which provides both ETFs as well as index funds through mutual funds. Next, we have State Street and PowerShares and Schwab as mentioned. There are a bunch of others on this list that are worthy of your research and review. I would also like to reiterate that Fidelity Investments has lowered their management fees on some of their broad equity index funds down to 0% per year on the broad equity index funds. So that's worthy of your review as well. Now, you've seen this chart before, and the reason I bring it up again is because it's this purple line that we as passive investors are most interested in. We're not talking about getting in and out of the stock market over time. We're not talking about putting everything in investment grade bonds here or real estate for that matter. We're talking about getting a diversified asset allocation that is properly weighted so that you maximize reward to risk. And I talk about this concept of maximizing reward to risk in the previous video. But this is the solution to getting away from the reptilian brain, this emotional approach to trading. And it's this optimal mix which maximizes reward to risk that is, in my opinion, the savior for, if you want to call it that, it is the antidote for the reptilian brain. We talked about how the reptilian brain, how this knee-jerk reactions of, this highly emotional approach to trading and flipping stocks and bonds, and it's very interventionist. It's very high commission oriented. There's a lot of stress involved. There's a lot of ego involved. Now, I'm not a psychologist or anything, but if you want to be a passive investor, you got to kill this egotistical approach to getting in and out of the market. And the way you do it is by getting your overall asset allocation right using index funds. You get a mix of stock index funds, you get a mix of bond index funds and ETFs, and you get the asset allocation right, you set it and forget it, you turn off all the screens, you turn off all the internet articles and all the newspapers that tell you that it's the worst time in history to be an investor and it's the best time to be in the market and all this. Turn it all off. Just turn all that stuff off and just get your asset allocation right. Follow the purple line over time through thick and thin, once a year rebalance just to get the balancing back into place, and you'll do great. Every now and then there'll be a down year, but not to worry because those down years are followed by up years over time, and you'll get a nice smooth equity curve that will generate real returns. And if you follow this simple process correctly in a disciplined manner, it's amazing how the compounding of the growth kicks in, and you'll do really spectacularly, especially as you get into the later years in a retirement portfolio, for example. It's those last years where the compound growth really kicks in, and so the earlier you start with this type of approach, the better. And I might add, you don't have to brag about this to anybody. Just keep it to yourself and you'll do fine. So to recap some of the takeaways from this lesson, point A, humans by nature are terrible market timers. We've seen that in the Dalbar studies that show that we seriously need to avoid and bypass this constant need to prove that we can time the market, that we're better than the market, and all of this. We got to kill this reptilian brain to get things right over very long periods of time. Point B, the stock market is very volatile and it's hard to figure out the market direction. Most investors simply should stay away from market timing because they don't have access to a very competitive market timing model. And even if they did, would they have the discipline to follow the signals generated by a market timing model? Point C, we're aware of the fact that it's important to have stocks in your portfolio in the form of index funds in order to beat inflation, because keep in mind, companies exist because they want to generate earnings. They're generating profits. And so they're actually using leverage themselves to generate earnings over time. And it's this profitability incentive that we can latch onto as stock index fund investors. And this is what helps us beat inflation over very long periods of time. Granted that in the short run there are fluctuations and high volatility in the stock market occasionally, and bear markets exist, no doubt about that. But over very long periods of time, you will make money in the stock market. It's just a matter of your time horizon. That's a very, very essential question. And we'll talk about time horizon more in another video. But the best strategy for most investors is to stay passive. Just set it and forget it once a year. Go with a solid asset allocation that's going to optimize reward to risk, such as the optimal mix that I showed you, the purple line. And we'll get into the breakdown and the weightings of this optimal mix in a subsequent video. So stay with the program here. As we've seen, the blue line was the investment grade bond fund index. It generates steady income over time, and as I mentioned in another video, it moves inversely to the stock market during severe bear markets. Investment grade treasuries will outperform. So it's this yin-yang balance effect that we need to factor into our passive asset allocations. Remember that time horizon is a significant factor in determining how much you should allocate to stocks versus bonds. This is something that I'm going to cover in another video. Essentially, what you want to keep in mind is as you near retirement age, I would suggest it's somewhere around 57 or 58. As you're approaching your retirement, you want to scale down your asset allocation to stock index funds, because if you suffer through a bear market, it may take 10, 15, 20 years to recoup any losses from that. Meanwhile, retirees are making withdrawals from their retirement nest eggs. If you're making withdrawals as the market's going down, there's not going to be the money there to put it back in for the rebound. So that's another very, very important reason why seniors should scale back allocation to stock funds and play it more conservatively. The goal is to generate anywhere from 7, 8, 9% a year on average. There will be an occasional down year here and there, even with the optimal asset allocation. There are negative years, but they're not that severe. It's not like you're going to have a negative 20% year. The greatest down year I've experienced or seen in my research and review of this optimal mix strategy is like 5 or 6%. A 5-6% drawdown in your overall asset mix is not going to kill you. You'll make that back in subsequent years. So if you're averaging about 7, 8, 9% a year, and you're taking advantage of the power of compound growth during your earnings years, particularly adding contributions on a monthly basis, paycheck by paycheck, you should do quite well over the long haul. I talk about this in greater detail in another video about a student that I had by the name of Gilbert, and I call it the Gilbert Millionaire Spreadsheet, named after him because he asked me about this long-term investment strategy. So that's pretty much it for this lesson. I hope you enjoyed it. I would highly suggest that you have a look at the other videos as part of this series, because they all sort of go together and help you understand this whole passive asset allocation approach. Thank you very much for watching. I'll see you in the next video.